All right, so we just finished up the creating the amortization table for the discount bond. Now we're going to move into the premium bond and kind of repeat that process. Whether it's discount or premium, if you remember, the contract is exactly the same. And so our N isn't going to change, our payment isn't going to change, and our FV isn't going to change. The only thing that's changing here is the purchase price. And so with the premium, the purchase price was $1,030. If you remember the discount, it was $975. In this case, it's $1,030. And if you remember with the discount, um, the yield or the bond yield, which is what we're going to solve for here, the bond yield was more than the semi-annual rate, which is 7.5% divided by 2, or the stated rate. And again, the whole idea is because the market demand for interest was more than what the bond was paying, therefore the price is going to be discounted. Now, in this case, you can see that the price is at a premium, which tells us that the interest rate should be lower than the stated rate, meaning that there's more demand for this bond. So it must be the case that this bond is paying more interest than what the market demands. And again, for different companies, that required discount rate is going to be different, and over time it's going to change. And so in this case, kind of as we would expect, that interest rate is 3.3169%, which is less than the semi-annual rate, the semi-annual stated rate of 3.75%. But again, you solve for that bond yield, and then we use the time value of money that we just solved for. We just kind of brought that table up here, and we're going to use that to create our amortization table. And so initially, the balance in the premium account, which we'd already calculated per bond, is $30, which means the amortized cost is $1,030. So if you remember with the discount amortization, the amortized cost was the par value, $1,000, minus the discount balance. And in this case, because it's a premium, it's the par value plus the premium balance. And so over time, this amortized cost is going to get smaller and smaller and smaller until eventually we're going to end up at $1,000. So again, conceptually, the way we talked about it was that with the discount, that in terms of interest, I made the interest payments. And then another form of interest is that I paid $975, or I bought it for $975, and I was going to get $1,000 at the end, which means there's an additional amount of revenue that I'm earning. In other words, there's an extra $25 that I'm getting, and we're going to classify that as interest revenue, and we're going to record it sort of systematically throughout the remaining life, with every single interest payment using the effective interest method. Here, we're going in the opposite direction. So I'm getting I paid $1,030, but I'm only getting $1,000 back. And so my total interest on this investment is my interest payments, which are, the same 37.50 all the way down, but now it's less the $30. In other words, I'm sort of not getting as much interest as my payments because I'm not getting as much when it matures. So it sort of works against it. So as we work through it, instead of the interest revenue being the interest payment plus the amortization of the discount, in this case, the interest revenue is going to be the interest payment minus the amortization of the premium. And the way that we operationalize that, again, same payment, the interest revenue is calculated as the yield times the prior amortized cost, so 3.3169% times 1,030 is $34.16. The difference between these two is the amortization. And again, over time, that premium balance is going to go down. So we went down from $30 down to $26.66, which means the amortized cost has been updated against the par value plus the balance in the premium. But again, notice that the interest revenue is the difference between the payment and the amortization of the premium. Again, it's sort of everything's opposite than the discount. Of course, we continue that process all the way through, and that's how we would calculate our amortized cost. Looking at just sort of some conclusions that we can draw. Sorry, I'm looking at the time and it says it's been 8 minutes. I don't think that's right, but we'll figure it out. So what can we conclude by comparing the bond purchased at 97.5 versus 100 versus 100.3? So just conceptually, what are our takeaways here? First of all, we know that the bond, when it's purchased at 97.5, that means it is purchased at a discount. And again, as we discussed, that means that the yield must be more than the contractual rate of interest. That sort of two things work hand in hand. If it's a discount, the yield is going to be more than the stated rate. At 100, the yield and the stated rate are going to be equal. And then at a premium, again, when you buy it at 103, that means it's a premium. And in that case, the yield is going to be less than the contractual rate. In all three cases, over time, the amortized cost is going to go from that initial price to the par value. So from the discounts perspective, it starts at the sort of below par and works its way up. From the premiums perspective, it starts above par and works its way down. And of course, if I issue it at par, it's just always at par the whole time. All right, so we're going to record the interest payment using the 97.5 scenario. And so we're going to start with the June 30th payment. And again, for these payments, we're just pulling information from the amortization table. And so again, on 6/30/2025, the cash that I'm going to receive is $37.50 per bond. And at that point in time, if you remember, I owed, I think, shoot, I forgot how many we had. Let me do that math. It's been a while. Yeah, you guys probably already know because you're following along, but that's okay. Yeah, if I could do the math, sorry. There we go. Yeah, 40, sorry. 40 bonds. So that is the amount of cash that we receive. Of course, the interest revenue is based on the $40.20. Again, we're applying it to 40 bonds. And so the total interest revenue is 1,608. And the amortization of the discount, again, the discount is a contra asset. So it has a credit balance. And so to amortize that account, we need to debit the account. And it's $2.70 per bond times 40 bonds is $108. So now we're going to do December 31st payment. Again, same accounts, just slightly different amounts because we're moving down in our amortization table. So the cash payment is exactly the same. The interest revenue, of course, is a little more because the interest revenue per bond is a little bit more. And then the amortization of the discount, again, the amortization is the difference between the two. So that amortization is a little bit higher per bond, which means the total amortization for 40 bonds is a little bit higher as well. So for the 100 scenario, much more straightforward. There is no amortization, so it's simply that the cash payment and the interest revenue are exactly equal. And the same thing, of course, is true on December 31st, 2025. So there's really not a lot going on there. Again, hopefully that journal entry is pretty straightforward. Again, if we look at 103, we need our amortization table again. Of course, now we're using the premium amortization table, not the discount. But we can see, again, we take the information from the table, and the cash payment is still the same, 3050 times 40 bonds. And then the interest revenue is that $34.16 times 40 bonds for $1,366. And again, this amortization of the premium on debt investment is a normal asset, which means it has a debit balance. And so to amortize that premium, we're going to be crediting that account. $3.34 per bond times 40 bonds is $134. Again, hopefully that's not too difficult. And then the 1231, we simply move down one row, same accounts, just slightly different amounts for the interest revenue and the premium on debt investment. So, and so those are our journal entries, hopefully not too bad. I'm debating on whether or not to sort of pick up. And all right, we'll start the next lecture. I'm going to stop this one, and then we will pick it up here pretty quick with the next topic.